Perhaps the single most important anomaly that now plagues our financial system, the artificial separation of commercial and investment banking.
Those blasted banks got us into this mess. They need to pay, they need to be cut down to size. That's obviously the popular sentiment today, but it also was the case back during the Great Depression. In 1933, you had a law put into effect, the Glass-Steagall Act, which effectively prohibited banks from engaging in insurance underwriting and investment banking. That law stayed on the books until 1999.
If we're still operating in the 1930s or 40s in terms of our financial services in this country, then we're going to find major industries in this country going offshore.
Now, on the surface, bringing Glass-Steagall back might be yet another example of overregulation, which has become, unfortunately, probably a bit of a hallmark of the current administration. This, combined with the proposed bank tax, the whole bailout rage in general, is maybe a bit counterproductive.
We want our money back, and we're going to get it.
But on the other hand, Glass-Steagall did work for more than 6 decades, and you could definitely argue that maybe it is a good idea to bring it back. After all, the big banks did go kind of nuts after Glass-Steagall was repealed to get bigger, take on riskier businesses, and maybe they do need to be reined in. So, should Washington party like it's 1933 again and bring back Glass-Steagall? Brian Jones thinks so, even though he doubts Congress will go for it. The first actual change I've seen from Obama in a year. Well done, sir. But getting this passed is a whole nother monster given the fight the banks will put up. He's definitely right. Banks have some very, very big lobbyists in D.C. You know that they would fight something like this. It is also debatable whether or not Congress even would want to go this far. This is definitely a pretty broad step. Jason Avery is also a fan of Glass-Steagall. He points out that in 1987, the Congressional Research Service prepared a report which explored the cases for and against preserving the Glass-Steagall Act. He quotes that number 3 was, securities activities can be risky, leading to enormous losses. As you can see, they basically predicted what would happen, but yet in 1999, the Glass-Steagall Act was repealed. Great point. That definitely helps strengthen the argument that we should bring Glass-Steagall back. Mark Kroller argues that new laws would not be needed if regulators weren't asleep at the wheel to begin with. Wonderful in theory, but the government has a pretty poor track record. It's easier to blame the banks even though the government was not doing their job. Kind of like blaming the kids for trashing the house, but not saying anything to the babysitter who let them do it. The SEC, the Fed, even the FDIC, which has been one of the better regulatory agencies during this crisis, all of them were definitely lax from a regulatory standpoint and could have done a much better job. Finally, one poster who also said the crisis is Washington's fault, but did not give his or her name, hey, if you can't trust the government, why trust the internet, wrote that, folks, Glass-Steagall is a crock. It's another case of the government blaming markets for the destructive actions of government-run central banks 1929-2009. Anyone supporting it is simply selling this country down the river to socialism, and it will make our economy poorer, less stable, and less resilient. Interesting theory. I do agree that the Fed does deserve a lot of blame, and it's been very unfortunate that Ben Bernanke has been trying to shirk some of the Fed's responsibility for their role in the crisis, but this might be going a little too far. I don't think we're on the river to socialism just yet, despite what this reader and many others like him or her definitely feel.